whom we see this morning from business advisory, tax, risk management, superannuation and investments, employment and HR, give their insights into the current economic and financial landscape that impact small to medium businesses around Australia during the pandemic and beyond. My name is Lisa Garrido, and I'll be hosting this morning, introducing the panel of thought leaders in their areas of expertise. I should also provide the following general warning that the views and opinions shared in this panel are designed for general information only and not designed to be taken as specific advice for your needs. Please feel free to reach out to any of us on our LinkedIn page, Business Insights, or our Facebook page, Business Insights, or reach out to us on LinkedIn as well. So let's get started. I'd actually like to start with you, Ian. Ian from Imperium Accounting and Tax. So let me introduce everybody first. I'd like to welcome the panel of thought leaders. Ian from Imperium Accounting and Tax.
Thanks for having me, Lisa.
Great, thanks. Bernard Tuimau from MGA Insurance.
Lisa, thanks for having me.
Hello, hello. And Sam Gareshi from MoneyClip Private Wealth.
Thank you, Lisa. Great to be here.
And Adam Lyle from The Biz Doctor.
G'day, Lisa. How are you?
Very good, thank you. Thanks everybody for being here. Ian, let's start with you. What is the update again on your area of expertise?
Thanks, Lisa. So today I just wanted to cover off on a little bit of the technicalities with JobKeeper 2.0 and what people need to do in order to make sure that they get that declaration in. So as we know now, JobKeeper 1.0 is well and truly finished. JobKeeper 2.0 is in play. In order to qualify, our September 2020 revenue needs to be 30% or more down on our September 2020 revenue. Now, normally with JobKeeper 1.0, businesses just had to go on and declare what their expected income for the current month was. JobKeeper 2 is a little bit different. So as of the 1st of November, businesses will be able to go onto the ATO, and if they qualify, they will be able to make their October declarations and receive those payments. Now, what they need to do is it is ideal that your September 2020 BAS is lodged by the date that you make that declaration. Now, the reason being for that is that once that September 2020 BAS is lodged, the ATO is then automatically calculating that 30% decline in turnover test on their end. So if you lodge your BAS and your figures don't meet those thresholds, then it's going to tell you that you're not eligible. Now, if your BAS isn't lodged, you still do have an option to enter in what you think your estimated September quarter turnover is going to be. However, there is a catch with this because it does say that if this then varies to what you then lodge as your September BAS figures, we will contact you. So really the advice is to make sure that your September BAS is lodged before you go on and make that declaration, just to avoid those unnecessary phone calls. And it's a little bit, there's a bit of speed that's required with this because normally a BAS agent or tax agent, we get the extension to lodge BASs up until the 25th of November. But remember that the JobKeeper declarations, they are only open until the 14th of each month. So they're open from the 1st of the month until the 14th. So really, all those BASs need to be lodged at the latest by the 14th of November. Just a couple of other things I want to touch on there with JobKeeper 2.0. So employers have until the 31st of October, which is only 5 days away, to make sure that they've made those top-up payments for fortnights 14 and 15. So fortnights 14 and 15 ran from the 28th of September to the 25th of October. So the ATO did say that employers have until the 31st of October to make those top-up payments. And remember, when we talk about these payments, we've got tier 1 and tier 2 employees now. So tier 1 are those ones that work more than 80 hours in the period, and tier 2 is 20 hours. And the rates are different. So I want to run through the rates, and then I want to look at the gross amounts and the net amounts that will need to be transferred by the 31st of October. So for Tier 1 employees, we know that the payment drops from 3,000 gross down to 2,400. So that works out to 1,200 a fortnight for Tier 1 employees, and the net amount on that is $1,084. Okay, so multiply that by 2 is what the employer would need to make sure that they pay to the employee as a top-up rate by the 31st of October for that employee to be eligible for those Tier 1 rates. Now, for the Tier 2, it's $750 a fortnight, and that works out to 744 net. So once again, in order to be eligible for the October payment being paid in November, the employers, if they haven't already done so, they would need to make those payments to the employee by the 31st of October. So there's just some really important things there. The other one is, so how is the ATO going to be told whether employees are Tier 1 or Tier 2? So with the single touch payroll software, there are now buttons embedded in those softwares, in Xero and MyOB and other ones, which enable you to select a box for an employee, and we say, yep, this employee is Tier 1 or this employee is Tier 2. That information is then linked to the ATO. So then when you go on and lodge your declarations with the ATO, they are going to realize which employees are Tier 1 and which employees are Tier 2. So it's really important that that single touch payroll software is up to date with distinguishing between Tier 1 and Tier 2 by the time that you make that declaration. And I'll just reiterate the fact again, really important that you lodge your September 2020 BAS before you go on and make those declarations, because that's what the ATO is going to be using in determining whether that business is eligible for JobKeeper 2.0 going forward. So that's what I wanted to cover off today, Lisa. So thank you very much.
Thanks, Ian. You guys will be pretty busy if people aren't really listening to the advice you're giving, and do the lastminute.com scenario for these things. That's excellent time frame tips there. And for our viewers, please just replay the recording just to revisit Ian's little discussion there so that you're aware of the deadlines if you haven't already discussed that with your accountants or bookkeepers or tax agents. Okay, now, Bernie, over to you.
Thanks, Lisa. Lisa, a man has lost his dispute with Suncorp after he lodged the claim for loss of rental income from a cancelled holiday booking during COVID-19 pandemic. The gentleman held a landlord's policy covering his property. However, on this basis, he leased the property under a rental agreement similar to an Airbnb type style product. He lodged the claim with Suncorp. Suncorp denied the claim under the basis that there wasn't a fixed rental agreement in place. Now, it's very important for, I guess, property owners who do lease out their property on I guess, short-term leases or things such as Airbnb and other platforms like that. Basically, Suncorp said that the policy wording, and I'll read this clause to you, a loss of rents or tenant default section of the policy stated, if your tenant stops paying the weekly rental income during the term of your written rental agreement or periodic rental agreement, and during the period of insurance but does not leave, we will pay you the weekly rental income for a fixed period of 14 weeks. Or if you have rental agreement, up to 2 weeks if you have a periodic rental agreement. So this clause is a pretty standard clause, and the gentleman lodged a complaint with AFCA, who is the Australian Financial Complaints Authority, citing that he was told by the call centre official that this should have been picked up under the policy. Now, this is a classic scenario of general advice that is given by these direct insurance versus personal advice that is given by insurance brokers and insurance advisors. It's quite important to really know the difference. Had this gentleman taken the policy out through a general insurance advisor, he would have been told, and his personal circumstances would have been taken into consideration, and the insurance advisor would have been able to provide a more appropriate product that suited his, I guess, financial needs. Now, this is pretty common. We're currently in a scenario where you know, a lot of property owners are unsure of what's sort of happening. What we are seeing in the landlord market is that insurers are increasing rates on rental default. Although we haven't seen a huge influx of rental default claims during the pandemic, and whilst we are in a recession, insurers have pretty much put an embargo on rental default. And the reason being is that under a landlord's policy, you've got several sections. And as a property owner, some of the biggest exposures that you want to make sure that you're covered for is things such as loss of rent. So loss of rent from things such as fire, property damage or physical damage, malicious damage caused by your tenants, and rental default in the event that your tenant falls on hard times. Now, these are things that as a landlord, you want to make sure are covered. However, in a lot of scenarios that we're seeing at the moment is that insurers are not offering cover. Insurers are not offering cover for rental default. And the reason being is because we are in a pandemic. So it's important for you guys to make sure that if you are covered for rental default, although there are premiums are increasing in this space, make sure you work with your current insurance broker to make sure that you keep this cover. What we're seeing at the moment is we're getting a lot of phone calls from property owners saying, you know, my landlord's insurance has gone up 10% and, you know, I want to see if I can get a better deal. Unfortunately, at the moment is if you do have the cover, make sure you stay with your current insurance provider and your advisor and just wait out this current season until hopefully we get out of the recession, which I think we'll be in for quite a while. And that's the advice from me this week, Lisa.
Thanks, Bernie. It's just interesting you said that. I just had a business meeting with some trusted advisors this morning. And to my personal opinion is I just do not understand how particularly business owners or investors don't have relationships and very strong relationships with their insurance advisors. Just going direct to insurers at the moment is just not the way to go in this very, very challenging period. And advisors can really navigate through some of the challenges that the insurers may not disclose to you at the outset. So very good advice there, Bernie. And that was a consensus from that business group this morning. So thank you for that. Thank you for sharing that. Adam, over to you now. What tips have you got for us this week?
Well, it's interesting because it actually has a bit of a tangent on both Bernard and Ian. This week, I met with a client who was referred to me by their external accountant. And their accountant was really worried about an exposure that they had because one of their key suppliers had gone broke. And their supplier not only was unable to provide any more goods goods that they were being able to use to continue to on sell, but all of the stock was being held by them as well. And the liquidator of that entity of the supplier was refusing to release that stock. Now, none of that stock was insured. And in fact, they did not have an insurance policy to cover them for the failure to supply those goods. And as a result, they were in breach of the contract that they had with one of their customers. Now, this is not an uncommon event, but can I say this? It's going to become more prevalent in the coming months and in fact, probably in the next couple of years. So the reality is that I was able to negotiate with the liquidator in getting some of that stock released because I was able to establish that the stock was no use to anyone else. It was specifically designed and manufactured for this client. But it takes a bit of nous and negotiation to be able to deal with liquidators who can be quite difficult to negotiate with in that environment. Funnily enough, in the middle of all this, quite literally on the day of, the morning of when I arrived at the client's premises, his number one right-hand man employee told him he was leaving with no notice and actually had already set up a competing business on the side. So they were in a world of hurt. Now, thankfully, we're able to get things under control, negotiate with the liquidator. They already had an insurance broker involved, who actually had told them, hey, you need to be insured for this. And there was a whole pile of email material going backwards and forwards over the last couple of months. So, you know, I said, you guys are crazy. You need to get all this sorted out. And it was one of those cases where they weren't listening to their accountant, they weren't listening to their insurance broker, and they had set up their business in such a way that they weren't able to specifically protect the goods that had been manufactured and were being held as a stock item at another person's premises. So there's a whole pile of issues there that came out. It's not insurmountable. It's something that can be sorted out. Prevention in this situation is far better than the cure. Ultimately, the cost of getting all this back off the liquidator is going to be an additional cost. They won't be able to get away with that very cheaply. And of course, there's going to be lawyers involved and they're not insured. So the loss incurred and the potential claim against them by the breach of contract situation is going to need to be negotiated out with the lawyers. Anyway, I just wanted to share that story with you. It goes along the line exactly what we're doing here, and we're trying to prevent disasters across the board with all of us giving that advice. And I think it's an example of where people who are hopefully listening to Ian and Bernard and Lisa and Sam is able to take action before things eventuate. The reality is issues will come up, obstacles will come up. Issues exactly what I've just described will happen. You need to prepare for those days. So that's it from me, Lisa. Nice and short and sweet, and I hope that's helpful for all of our viewers.
Thank you, Adam. And really the poignant point there is that nothing is insurmountable. If you are surrounded by the right advisory team or the right key people to help you navigate through a solution to that. Thank you, Adam, for that. And that's definitely the solution you provide to your clients. Thanks for sharing. Sam, over to you. I know there's a lot of updates from you in terms of superannuation investments as well as interest rates. Over to you now.
Okay, great. Thank you very much, Lisa, and thank you, other panelists. Firstly, in relation to interest rates, we have an all-important Reserve Bank meeting happening on Melbourne Cup Day. So Reserve Bank always meets on the first Tuesday of every month, other than January. And we should get some more guidance about any rate movements. There is some expectation that potentially the rates may move, but that's obviously not guaranteed. There's also a conversation around the fact that Reserve Bank will be, as mentioned last week, will be in the bond market, and that will have an impact on the fixed rate loans. What we have noticed is that just a very recent week, some banks are cutting some of their margins by a factor of 0.05 and 0.1% in variable and some selected fixed rate loans, but that's not widespread as yet. So this might be a sign of things to come in terms of what's been going on there. My suggestion is that wait and see what happens after the RBA meeting before you make any decision around that. We're getting lots of inquiries about refinancing at the moment. Our suggestions also is to make sure that you're taking into account how you live with those loans over time, rather than just at the point of refinance, where most people look at it and say, what's the best deal I can get at this particular point. Some of these refinances have some shiny lights attached to them with refinance rebates, etc., and that could be appealing initially, but maybe not over time. So just very important just to make sure that you're very much thinking about how you live with your loan over time, not just at the point of refinance. And now last week, markets were pretty indifferent in Australia. The market went down by about 0.3%. We had a big start to the week, but then it just fizzled out. And of course, Storm won the NRL Grand Final last night, and Storm is probably what we're going to have for the US elections and Biden leading at the moment. And of course, with Vic still in the state of flux, that doesn't really help our economy, get a good kickstart, given that Victoria is such a big part of our overall country's GDP. And so I guess, we'll be waiting with a bated breath as to what Daniels will come out next. Now, there are some optimism at the moment on the back of the US reporting season that's just started. But, there's so much, there's still so many issues around COVID. Records are being broken in terms of what's happening in the US and Europe, and even just parts of South America. So these uncertainties are still going to be about. And so I caution you about making any hasty decision about investing in a very big way right now. I want to touch base on a particular rule in super that you might find useful, especially if you've been going short on putting money into super in the last 6 to 12 months. It's called the carry forward rule. So basically from the 1st of July 2018, if you didn't use up your whole $25,000 worth of concessional contribution for a particular year, and your balance is less than 500K at 30th of June of the prior financial year, you can actually make up those 25,000. So for example, if you put in 20,000 in one year, in the following year, you can put up 30,000 to make up the difference. And you can do that for up to 5 years, going back to 1st of July 2018. So for those who are concerned about they're not going to have enough or they've gone a bit short for a period of time, don't worry. As long as your account balance is less than 500K, you have a mechanism to be able to catch up with that, and obviously engage with your advisor, speak with your accountant to talk those through. Now, of course, investing wise, this is a time that a strategy called dollar cost averaging comes in very handy. DCA for short. That's when you invest a smaller amount of money on a regular basis, say monthly, into the same investments that you already have. It allows you to buy more units when prices are lower, whilst a little bit less units when prices are higher. But ultimately, you'll have a better average return, average cost of purchase, and of course, you'll minimize your risk because you're not investing everything in day one. When you invest everything in day one, in one day, I should say, essentially it's feast or famine. It could be the best day you invest, it could be the worst day. So having that diversification, that really helps. And for me, that's my tip for the week.
Thanks, Sam. There you go again. Really good tips from the advisors. Thanks for that information on superannuation as well. So what I'd like to cover today from an employer and HR perspective is really more about employee burnout and the simple signals to watch out for that. I know these things to be really simple, but often simple things are the ones that get missed out, right? So there's no denying that most of us are really struggling to keep up with this hectic pace that we're now used to. You have back-to-back meetings without a breath. You often have your lunch on the go, have dinner while you're getting the kids sorted as well, and still, putting off any triggers in your mobile devices. This is what we are now used to facing because we can't help it. That good employees really have can-do attitudes, and people with can-do attitudes often cannot switch off. So it's really time to take action as employers in how you can help your people or your employees, your valued assets, break the stress-fueled lifestyle that's already crushing their energy, probably crippling any productivity in your business, and really sapping the well-being before it's too late. So a white paper released by Virgin Plus has actually stipulated the following stats. 67% of employees report feeling burnt out on the job now. $180 billion have been attributed to healthcare costs related to workplace stress. 9 in 10 HR professionals name that poor health, high stress, lack of sleep as factors affecting employee well-being. And 46% increase in healthcare costs are attributed to stress in the workplace. So what can we do about this as business owners, employers, employees? Firstly, and I talked about this a few weeks ago now, that as managers, we do need to create a caring team environment. I know that sounds a bit cliched, but really what that means is you need to help your employees or your team members feel comfortable speaking up when they're facing challenges. What we're really doing is we're humanizing this experience. It's okay to be vulnerable is what we're actually telling our team members to be. Then as managers, we need to be educated on how to tell or how to see the telltale signs of employee burnout, especially when it's happening to our top employees, our top performers. So what I'd like to go through now is what are some of these signs? Okay, one, a serious slump in productivity or work quality. So what that means is when your top-notch employees turn into unreliable ones. That is a biggie. So the warning signs are consistently missing deadlines, frequent client complaints, an A-plus employee whose performance dips in comparison to months or years that have passed. That's number one. Second signal, an uncharacteristically detached or disengaged workup. So what does that mean is when employees disconnect or lose their spark or their life or their energy as they work. The warning signs are poor communication with their colleagues, disinterest or low enthusiasm, in fact, even when there's things to be enthusiastic about, or a former team player who no longer collaborates with the group. These are signs. Number three, and my final signal, is the unusually pessimistic or cranky person. All right, what does that mean? When the team cheerleader, again, we're talking about your top-notch employees, turns into Debbie Downer or Donald Downer. Really, that's a classic example. So warning signs, ongoing negativity, constant complaints, a go-getter employee who can no longer be encouraged. So that's my tip for the week. I just want to discuss the telltale signs that we should already know about. And next week, I'm going to cover some simple ways to help beat those. So that's it for me, guys. Now, what I'd like to ask everybody is do we have any questions from members in the panel?
Yeah, I've got a question. When people are in a situation of making absolutely critical decisions that have an effect on so many other people, Lisa, just like the referee last night, made the unbelievable decisions about a number of different factors of the NRL Grand Final, which of course would have pleased so many, but devastated so many others. How much of an impact, do those sorts of decisions have on your people within your organisation?
Huge impact is all I can say, mate. No, but on a serious note, does anybody want to answer that question, by the way? Because really, I'm very disappointed. No, I mean, this is where I think, particularly in this pandemic period, where we are definitely encouraging collaboration. Really, the first, I always say the fish will always rot from the head, right? So when the managers in the workplace actually stop making unilateral decisions, right, and actually ask their team members advice and what would work for the team or what would work for the business, that is always a good place to start.
So, like when the referee asks for the video referee to make a decision, and what happens when the video referee gets it wrong as well?
Well, there you go. As long as we're not apportioning accusing fingers at each other, perhaps.
Anyway, that's my contribution. As a referee, that's my contribution.
Good on you, mate. All right. Now, Ian, I actually have a question for you. What is the impact when the businesses don't actually meet the deadlines that you're talking about? I mean, what's the catch up here? I mean, is there like a fallback period?
Well, okay, so let's talk about the declaration needs to be made by the 14th of the month. If that isn't made, theoretically, you're not meant to get paid. However, you can call the ATO and put on a good story and ask them to still make the payment. But you do not want to leave it up to that. Absolutely not at all. You want to make sure that you meet that deadline by the 14th.
And how compassionate do you reckon the ATO will be?
They're starting to run out of compassion. Absolutely.
Yeah.
So you would not want to rely on that. And if you did rely on that, you would not want to bank on getting those payments at all.
Yeah.
I'll give you an example.
You missed the deadline. Sorry, you missed the deadline. Be prepared not to be paid.
Absolutely.
Yeah. Okay.
I'll give you an example of the lack of compassion starting to show through. I had someone who came to me during this last week that had received a director penalty notice for unremitted GST during the COVID period. As I didn't think that would happen already, and it's starting to happen. So people need to be aware that directors can be personally liable for GST that they haven't remitted to the tax office.
That's always been the case. But yeah,
No.
thanks for reminding us. No?
It hasn't always been the case for GST. It has been for other elements, but not for GST. It all happened, those changes happened earlier this year.
Speaking of those, thanks, Adam. Speaking of those changes, Sam, you know, the carry forward rule, is that only because of this pandemic period, because of the changes? So that's always been the case?
No, it hasn't always been the case. It only came in as of 1st of July 2018. So it was just announced in previous
All right.
budget.
Okay.
Yeah, but it's in action now. Many people don't know about that rule, but it's important to know that, you know, if you've missed a period and it's post 2018 1 July, you have a means to be able to catch up on that for up to 5 years.
I think that's particularly important for the business owners who watch these webinars every Monday. You know, obviously cash permitting. You know, why not play the catch up, or perhaps for employees if they want to do their employee contributions themselves. That's good. Thanks for letting me know that. I think I'll alert clients on that. I don't know why I didn't know that. Thank you. Do we have any other questions or any other feedback or comments? No? Great. Well, on that note, thank you very much for our viewers for watching Business Insights on Monday at middays, and we'll see you next week. Thanks, panelists. See you next week.
Thank you.